Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
One of the reasons that is really key, a real key reason that these countries will stay in the system is because of the fact if they leave right away, their cost of borrowing will jump tremendously. I believe we're about 200 basis points now between 250 between Portuguese bonds and Germany. Now, if Portugal said we're leaving the system, international community would probably say, okay, your bond yields, if you want to borrow, are probably going to jump to, who knows, 1,000 basis points above Germany. So that's part of the reason that's keeping these guys in the system. But as I said, as the pressure grows for more austerity in order to maintain some semblance of budget deficits relative to GDP, and the pressure grows for them to reduce wages in a very, very big way to bring their labor productivity numbers back in order, it becomes more and more politically unviable for these guys. And as we know, most of the time politics trump legitimate or cogent financial decisions, and that pressure is growing in a very, very big way. As I said, the overall incentives are fading. As the yield spreads go higher for these guys compared to Germany, their incentive to stay falls. As the demand continues to fall across the Eurozone from these countries and also from the European emerging markets in Eastern Europe and Central European economies in a very, very big way, Germany's incentive to stay in the system falls because their captive export market is gone away. And that's why you're seeing the growth in Germany just tumble in a very, very big way and surprising the analysts. There's no demand in Europe. There's no demand in the U.S., obviously, and there's no demand in Japan for a lot of their high-value manufacturing goods and automobiles. So the incentives are changing very, very rapidly ever since the credit crunch started. And one of the biggest reasons that we see the danger rising for a breakup is there's just not enough money to go around to paper over the incredible exposures that we're seeing in the system. Literally, there's trillions of euros needed to keep the pigs in the Eastern European, Central European economies from collapsing. Huge, huge toxic exposure on the Eurozone banking system balance sheets. This is an estimate we saw recently, and this is low compared to what the European Commission estimate is, and I'll get to that in just a second. This comes from Lido Research, showing that there's 7.7 trillion Eurozone banking exposure in the system, 1.6 trillion from Eastern Europe. Eastern Europe is basically dead in the water. Eastern Europe borrowed primarily from international banks, mostly European banks, Spanish banks, Italian banks, Austrian banks, which are probably in the worst shape, Greek banks. Everybody was getting involved in the Eastern European game when everything was on the upswing and credit was free. These countries are close to default. They have no internal source of funds, and the international banks aren't lending anymore. When the Eurozone got into trouble, the major banks in Europe brought money back to their home base to shore up their own balance sheets, and you're just not seeing any lending. The IMF has papered over some of this problem and has given emergency loans across Eastern and Central Europe, but they're out of money, basically, and now we have the European banking system sitting with a 1.6 trillion exposure to Eastern Europe that continues to get in trouble every day. There was a little problem in Latvia just yesterday. And Latvia, again, not a powerhouse, needless to say, across Eastern Europe or the Eurozone, but I think and we refer to it as the canary in the coal mine. Latvia was trying to raise $100 million on a debt issue yesterday, and nobody showed up. Zero, none. They got nothing. IMF estimates, and that their economy is going to contract 18% this year, 18% decline in GDP. Now, Latvia was one of those countries that was just going straight up from all the funding they were getting from these European banking system. Everybody wanted to get involved in Eastern Europe when credit was free, and now all of it's been taken away. You have the same problem in Hungary, same problem in many of the other countries across the zone. We saw a very startling number just recently that relative to GDP, net foreign exposure, Hungary, net foreign exposure in terms of lending to the country as a percentage of GDP is 99%. So Hungary has a 99% lending inside the country from foreigners relative to GDP, and the foreigners aren't lending anymore. And most of that lending to Hungary, 99% of their GDP, was done in other foreign currencies because Hungary was borrowing euro and borrowing Swiss francs because there were much lower interest rates than the Hungarian forint to fund all this growth. So they have a dual problem on their hands. They have no liquidity, no sign of future lending coming in, and most of their exposure is in foreign currencies. Hungary is very close to bankruptcy, and again, they got a emergency IMF loan. Hungary is a lot bigger problem than Latvia, but Latvia, as I said, is the tip of the iceberg, but I think is a good representation of the overall international investor concern of Central and Eastern Europe. $2 trillion exposure to other export-driven economies around the world from the Eurozone, and $4.1 trillion exposure to the Eurozone banking system and lending to the pigs. That all sums up to a tidy $7.7 trillion in exposure sitting on the Eurozone banking system. Put it into some perspective, the entire GDP of the U.S. is about $13 trillion. This is a huge number, and they haven't come clean on. But the number really looks tame when you consider what were some recently leaked numbers from the Euro Commission. And let me get these. I have these here. It's just this is the pull the covers over your eyes number. There's a number that was basically leaked out of the European Commission that was only supposed to go to the leaders of these various countries. And the Euro Commission estimates, adding all the things up, that the exposure to the Eurozone banking system isn't $7.7 trillion, but it's about $20 trillion is their estimate of the potential exposure in the banking system. Now, let's just hope they're not right. I mean, $20 trillion, that's 1.5 times of the U.S. GDP, 1.6 times of the entire U.S. GDP for a year. That number is just, as I said, very scary. Even if part of that, a decent part of that is true, you can see the incredible problems we have here facing the system and why the squabbling and these changes of incentives, when you overlay that on top of the incredible exposure, it's no surprise why you're seeing Germany start to pull away, start to balk from this. They don't want to put their citizens on the hook for this type of exposure. It is just too massive. So I think the numbers give some context to the political squabbling going on, not only at the ECB, but even at the state level. Needless to say, the other members of the European Central Bank from Austria, Portugal, and Greece are screaming for more lending out of the European Central Bank, more quantitative easing, more direct lending. It's just, and that's what's creating the big debate inside the European Central Bank. And Trichet, again, has done a marvelous job of trying to put a pretty face on this, but he's faced with an incredible, tenuous situation that could lurch out of control very, very quickly if U.S. demand or global demand does not return.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.